Welcome back. I'm Majid, and this is Financial Crime Awareness Hub. Here are the two questions to start with because they are really the same questions but two different angles to look at. First, your bank customer is actually someone else's customer. What's the compliance risk in that? Okay. Second, a bank process transactions for customers it has never met, has never verified, and does not even know they exist by name. Is that even legal? The answer to both is the same. Yes, it is legal. It happens every single day all across global banking. And today we are going to deep down and discuss correspondent banking, its risk domain, and payable through accounts, and the actual governance standards that some of the world's largest banks have agreed to follow, which is published via Wolfsberg Group. If you haven't subscribed to my channel, please do so in order to receive the updates on financial crimes concepts. Let's start with the basic relationship that makes this possible in the first place. What is correspondent banking? Imagine a small bank in one country that wants to offer its customers international wire transfers to, let's say, the US, okay? Setting up its own physical branch, in the US would be enormously expensive. Licensing cost, staff, premises, regulatory approvals. It's a completely different country, and it's of course such a complex process in altogether. Instead, that small bank does something much simpler. It opens an account at a bank that's already established in the US and uses that relationship to move on its customers' behalf. Okay, that's correspondent banking in the simplest form. The smaller bank, the one actually asking for the service, is called the respondent bank. The bigger bank, established bank providing the services, is called the correspondent bank. Okay, so these are the two first key terminologies that you need to remember. Okay, let's actually trace how the money moves in that relationship. Okay, so here's the flow. You see, the respondent bank's own customer initiated the transaction, could be via branch, via online banking, whatever it is. The respondent bank processes it and sends it onward to the correspondent bank. The correspondent bank then executes it, maybe by crediting a US account, clearing a check, or converting currency. Now remember that it could be possible that there may be more than one correspondent bank from the time a transfer is initiated until it reaches to the beneficiary. Okay, it could be that your relationship with, let's say, Bank of New York, okay, but your transfer ultimately is for the Standard Chartered. So your Bank of New York will move then the funds to Standard Chartered, and then the Standard Chartered will then move the funds to the beneficiary. Okay, so it's completely fine, and it's possible that more than one correspondent banks are involved in one single transactions. Okay, now here's the thing. The correspondent bank sitting all the way over there, okay, has never met, never verified, or even seen the name of that original customer all the way at the start of the chain. All it sees is the own customer, the respondent bank, because they have an FI relationship with the respondent bank. Okay, everyone behind that respondent bank is invisible to it. Okay, now the Wolfsberg Group, which is multiple banks, some of the world's, I would say, largest banks that publish globally respected standards for exactly on this particular topic, puts it in a plain again way that the correspondent typically has no direct relationship with the underlying parties to any transaction route through it. Okay, now let's go and discuss exactly why then the correspondent banking is risky. Okay, so number one, the correspondent bank cannot do proper due diligence on the end customer because it does not even know them, who they are, because their relationship is with the respondent bank only. Okay, it does not have the transaction level data it would normally use to spot something unusual, because everything arrives already bundled together from the respondent. Third, its knowledge of the respondents on AML program is often limited to a questionnaire. When you have the correspondent relationship being established, there's a Wolfsberg guidelines and the Wolfsberg questionnaire where they ask for your AML policies, your compliance programs, your board of directors, and all those things in that questionnaire. Okay, or maybe they may have an annual phone calls, yet it is still trusting that program to be done or in proper they have the proper due diligence and they are doing their job properly. Okay, and then it may also know who regulates the respondent bank. Okay, everywhere they know that who the regulator are, without really knowing how strong or weak that regulatory supervision actually is. On top, they may say that okay, FCA from UK is a strong regulator. Let's say UAE central bank is very strong and all general, but again, it's a perception as a common understanding and all. Maybe by looking, let's say they don't have any, they are not in the gray list of FATF or something, but on ground how strong they are, that they cannot understand, right? Now, here's something that probably a lot of people miss entirely. This whole conversation does not stop at banks. Okay, now here. Okay, so here's something, as I said, like people may miss. Everything we have described was framed around banks, a respondent bank, a correspondent bank, but the same risk logic doesn't stop at banks. Okay, the Wolfsberg Group explicitly notes that institutions should consider applying these same principles to non-bank financial institutions, payment service providers, money service businesses, FinTechs, and virtual asset service providers, or VASPs. Why? Because those relationships can carry the exact same or even greater risks. An unlicensed payment processor acting as a respondent creates the same arm's length blind spot that an actual bank does, sometimes worse. So none of this works without proper governance sitting behind it. Let's talk about that. Okay, so you see, according to the Wolfsberg principles, an institution needs a risk appetite for correspondent banking that's actually approved by its board, not just written by a compliance analyst and filed away. I am sure some of you may have heard the terminology risk appetite. Means like how much risk you can take for this particular relationship. Okay. Number 2, there should be a formal governance body overseeing onboarding, monitoring, and escalations with representation from both the first line, the people running the business, and the second line, the independent compliance function watching over them. This is not just a simple paperwork on its own sake. It's what stops we will figure it out as we go from being the actual policy. So what does that governance body actually checks when it's doing its job properly? Okay, let's look at those 6 factors. Geographical risk, where is the respondent based, headquarters, okay, and actually doing business. FATF, pronouncements on specific jurisdictions matters really a lot here. Ownership and management. Who owns this respondent? Who runs it day to day? And is there a PEP sitting in either seats? Number 3, products and services offered. Does it offer cross-border payments, cash-heavy products, or anything with low transparency into where the money actually is going? Then we have customer base. Does the respondent itself serve a lot of high-risk customers in high-risk sectors or jurisdictions? Then we have regulatory status and history. Is it properly licensed with its operator or the regulator? And has it faced any material regulatory action before? And finally, the quality of its financial crime controls, not just whether it has a policy document around AML, KYC, and these things, but whether that program actually works in practice. Now, some relationships are not just higher risk, they are really, hard no. What are they? Let's look at it. Shell banks. Okay, shell banks, as we know, are the clearest example, and this connects directly back to our shell company previous that discussions. A shell bank is a bank with no physical presence in the country where it's licensed and no connection to a regulated financial group. No meaningful management, no real office, just a banking license and a name. If you remember that video, this is the exact same idea, just applied to a bank itself. Alongside shell banks, the never do business with list includes unlicensed or unregulated banks and non-bank financial institutions. Any respondent where due diligence turns up, concerns that simply cannot be resolved, and any respondent whose financial crime controls are clearly inadequate and who won't, commit to fixing them. Now let's go back to now a new terminology called nesting, because there's much more, concrete way to understand that. Okay, nesting. You see here there are 3 boxes. Okay, so, and it is exactly what it sounds like, one hidden thing inside another thing, and inside probably you have seen, Russian wooden dolls. You open one doll, inside another one, inside another. So from the big they start and it becomes very small inside. Okay, so this is the same concept here. Now, for example, the Wolfsberg Group itself uses this as an example. A regional, let's say, saving bank offers correspondent service to a local savings bank in its area. It's small, ordinary, completely legitimate on its way. But now think about what that means for the correspondent bank at a very top of the chain. It's not one step removed from the real customer anymore. It's 2, 3 or more steps removed. Processing transaction for banks it has never even heard of, that it never agreed to do business with directly. Then you see, officially this is called also downstream FI, financial institution arrangement. Nesting is just the industry's nickname for it. Okay, and when it happens, the correspondent at the top is expected to take reasonable steps to actually understand the types, the scale and the geography of those downstream institutions, not just look the other way because it's normal. Now let's talk about the version of this relationship that removes even more of the distance instead of less. Payable through account. Now a payable through account, or PTA, has an official definition straight from FATF recommendations. You see, a correspondent account that are used directly by third parties to transact business on their own behalf directly. Okay, in simple terms, so the respondent's own customer might have a check writing privileges or the ability to give transactions instructions directly to the depository institution themselves or the correspondent. So in other words, a customer of a bank on the other side of the world can in practice behave almost like a customer of a depository bank itself, without the depository bank even formally onboarding them, verifying their identity, or even necessarily knowing their names even. So let's put these two things side by side, because the difference is exactly what probably the exam going to test you on. Okay, so on the left hand side you see standard correspondent banking. Only the respondent bank itself ever actually touches that account, and then its customers are represented but never present. Okay, on the right hand side, a payable through account, the foreign bank's customers step directly onto the account themselves. That's a meaningfully bigger gap in the oversight, because now individual people the depository bank has never verified are directly moving money through it. Okay, there's one more system I think worth understanding before we look at a real case, how all of this oversight actually stays alive over time. Okay, let's look at it now. Okay, now correspondent banking oversight is not a one-time checkbox. It's a continuous kind of a thing, or a loop. Okay, now due diligence findings inform what your transactions monitoring should be watching for. What monitoring turns up feeds directly into the next periodic review of the relationship. And that review can trigger fresh due diligence, closing the loop all over again. Now, the industry has the name for this, the feedback loop. Here's why I believe that it matters most. If you see any one part of that loop's break, say monitoring results never actually reach the people doing the periodic review, the whole system quietly stops working. So even though every individual piece still technically exists on the paper, let's look at how big these failures could be in the real world. Two quick details that I feel could trip people. First, same currency does not mean same risk. Now imagine two banks in different European Union countries, both using the euro, still have to treat their relationship as a foreign correspondent banking. Different countries carry different sovereign and regulatory risk regardless of the currency. Number two, your own family does not get a free pass here, I would say. If your bank offers correspondent services to its own branch, subsidiary, or affiliate in another country, that entity still gets treated as its own respondent with its own due diligence, not just waved through because it shares your logo, right? Let's look at how big these failures can get in the real world now again. Okay. In 2012, a major global bank agreed to pay close to around $2 billion to US authorities after a US Senate investigation found its Mexican banking business had moved hundreds of millions of dollars in drug trafficking proceeds through the US financial system. Okay, this was a huge amount. Why it happened? Weak due diligence on correspondent relationships was named as one of the central or important failures. The bank's compliance program simply wasn't equipped to see who was really moving money through the accounts it was providing access to. It's one of the most cited case studies in the entire industry for that reason. Now let's get back to our two opening questions and answer them properly. Remember that we start with that your bank's customer is actually someone else's customer, and a bank process transactions for people it has never met. Let's label it exactly what's happening. So this is as we said, correspondent banking at its core. So a respondent bank's customer moving money through a correspondent bank that's never verified them directly. If that respondent bank itself has other small banks relying on it, that's nesting or downstream. Okay, even more invisible layers stacked on the top of it when nesting or downstreaming happens. And if the foreign bank's customer get direct hands-on access to the account itself through their own sub-accounts, that's a payable through account, the most exposed version of this entire relationship. So you see, different labels, same underlying problem. What's that? Distance between the bank holding the account and the real person actually using that. So what should catch your attention when you are reviewing these relationships? Let's look at the red flags. Number one, the respondent bank is vague or evasive about who its own underlying customers actually are. Number two, transaction volumes that don't match the respondent bank's stated size or customer base. Number three, evidence of nesting, where the respondent appears to be processing transactions for other banks you have never approved. Number four, a payable through account where individual named sub-account holders were never disclosed or vetted at the time of onboarding. Number five, the respondent bank operates in or has customers concentrated in high risk or weakly regulated jurisdictions. Now let's talk about what you would actually do about it. Step 1, know your respondent. Okay, like you know your customer, which is KYC, you know your respondent, ownership, management, and the true nature of its regulatory oversight before the relationship even begins. Number 2, request and review the respondent's AML program. Don't just accept the questionnaire at its face value. Number 3, ask directly whether downstream's FI nested relationship exists and who those institutions are. Step 4, for any payable through account, require identification of the actual sub-account holders. Don't allow anonymous direct access. Step 5, keep the feedback loop alive. Due diligence monitoring, and periodic review, each one actually feeding into the next, not just existing as a separate boxes on a checklist. Now let's test what we have understood so far through a question. Alright. So a respondent bank maintains an account at a US depository institution. Several of the respondent bank's own customers have been issued individual checks and debit cards tied directly to the sub-accounts within that single account, allowing them to transact without ever being formally onboarded by the US depository institution. What type of account does this describe? Option A, a standard correspondent banking account. Option B, a payable through account. Option C, a nested correspondent relationship, also called downstream FI management. Option D, an omnibus account. You may pause your video. We'll see the answer on the next screen and we'll discuss what is the reason for that particular option to be correct. So option B is the right answer. Let's see why A, C, and D are wrong. Now, in a standard correspondent account, only the respondent bank itself transacts, never its individual customers directly. Option C is also wrong, which is nesting or downstream FI arrangements. Describes, another financial institution being served downstream, not individual customers getting direct account access. D is also wrong, and it is nice callback if you probably watched our previous videos where we discussed about omnibus or pool funds or suspense account with no individual attribution at it. Okay, the scenario is the opposite here. It's named individually attributed sub accounts, different risk. It's a different mechanism entirely. Option B is correct. This matches with FATF's own definition even. The respondent bank's own customer transacts directly on their own behalf via sub-accounts without ever being formally onboarded by the depository institution. That's a payable through account. Okay. Now, so let's bring everything together, what we have discussed so far. Yeah, so here's what I want you to generally take away from this video. So whether it's a respondent bank you have never verified, layers of nesting you cannot see, or sub account holders with direct access you have never onboarded, the common thread that you need to remember is the distance from that relationships. So the further removed the real person is from that institution's actually holding the account, the harder it becomes to know who you are really banking with. Okay, so now in our next video I'm planning to discuss loan back schemes where borrowing your own dirty money back from yourself with an interest. It sounds almost too simple to work, and that's exactly why it does. Okay, we'll discuss in detail in our next video. And as always, if you are preparing for the CAMS exam, remember AdviceQ Consulting have covered you via multiple options to support you during your preparations. Option 1 is question banks. We have around 1700 questions to support you in practice. We have crafted even notes which are concise, so that working professionals can specifically read the parts of which are really important prior to the exam itself, so that they can quickly go through, understand the concepts, and start practicing the question. With this approach, they can cut down the time of their study as well. Third thing, what we have also drafted is an e-learning course. It's deployed on a CourseBox platform. And in that, what we did is that we have trained an AI bot specifically on the study material. So if you are learning that e-learning course, and if you have a question, you just put it on the bot will specifically give you an answer according to the study material. So you don't need a trainer. You can study at your pace, whatever time zone you are. You get the best answers, much more than the trainers you expect, right? So you can find all this information on advicekeepconsulting.com, or reach out on the below email address or the WhatsApp number. I'm Majid. This is Financial Crime Awareness Hub, and I'll see you in the next video.